Okay. Welcome to the special webinar. My name is Dr. Stephen Sussman. I'm a professor of public administration in the Andreas School. I'm letting people in as I'm doing this too, so forgive me. In the Andreas School of Business and Public Administration at Barry University in Miami, and the co-founder of the Palm Beach Center for Democracy and Policy Research. Dr. Fleischman and I, Louise Fleischman and I, along with a team of dedicated colleagues, established the center as an outlet for the marketplace of ideas. The Palm Beach Center for Democracy and Policy Research is a nonpartisan public policy organization, a research center, and a think tank. We are a gathering of scholars, experts, and community stakeholders engaged in research and dialogue in an effort to create practical policy recommendations to current local, national, and international challenges. Therefore, the center encourages discussion and research from multiple perspectives. We believe that good policy is the result of reasonable dialogue and healthy debate. We believe in the marketplace of ideas. Thus, through publishing balanced articles and community engagement, such as tonight's webinar, the center aspires to provide a platform for critical thinking, analysis, and ideas to confront challenges that affect our world. Our core values of diversity, balance, and community define us and set us apart from other organizations. As an organization, we value diverse voices and views and see it as a means to create a healthy debate. The center provides a balanced platform where civilized communication, exchange of ideas, and inclusion prevail over party politics and dogmatic views. Our objective is to be a community and place of gathering for academics, professionals, elected officials, decision makers, civil society groups, and leaders. Please visit our website at palmbeachdemocracy.org. On the site, you will find links to our past webinars. Recent webinars include a program on cryptocurrency and its connection to foreign policy, academic scholarship versus ideology, the intersection of national security and the Florida tech ecosystem, and a number of events on the Middle East peace process, the military assessment of the Russian invasion of Ukraine, and many more. On our website, you'll find a donation button. We are a 501c3. Through your generous donations, we are able to bring you important and timely programs and articles. Tonight, the Palm Beach Center for Democracy and Policy Research is thrilled to present a very timely webinar, very timely, titled The Banking Crisis and Its Implications, featuring Professor Donna Anderson, adjunct professor at Palm Beach State College and former professor of economics at the University of Wisconsin. The moderator for tonight's event is Joel Levin, a professor of law and philosophy and one of our center's most prolific writers. We welcome your questions. You can write your question in the chat box, or when we are ready for questions, you can raise your hand either virtually or otherwise. I now turn this over to my colleague, Professor Louis Fleischman. Luis, you're up.
Yes, thank you so much. Thank you so much, Steve, for this kind introduction of the center. And I want to repeat that our center focuses on issues related to democracy, which includes democracy in our country, ability to discuss every issue that comes to the table in a civilized manner. Steve actually mentioned some of the programs that we had, including, the protest in Iran, the, civic responses to Russia's war in Ukraine, implications of Florida's new election laws. And you can go to our website, palmbeachdemocracy.org, and see all the programs we have had. I also want to thank particularly my friend, Dr. Emmanuel Alvarado from Palm Beach State College for agreeing to co-sponsor this program. Thank you so much. With Emmanuel, we work together in the college and in many programs. And now for the first time, we are working together in this program for the Palm Beach Center, with the Palm Beach Center for Democracy and Policy Research. So I want to introduce right now, before I call on Dr. Alvarado to say a few words and introduce our main speaker, I would like to introduce our moderator. Is Professor Joel Levin, Dr. Joel Levin. For 4 decades, Joel Levin has been a commercial litigator and civil rights advocate, university teacher and author. He wrote actually 4 books, include How Judges Reason, Revolutions, Institutions, Law, Third Wars, and a few other books. You can read his entire bio in our website. He also wrote a book called Marrano Justice that focuses on the life of Justice Benjamin Cardoso. He's presently working on another book called Another Way of Seeing Things, Sephardics and the Creation of the Modern World. He received his BA and MA at the University of Chicago, his JD at Boston University, and his PhD at the University of Oxford in England. In addition to founding 2 high-tech companies, he has taught law and philosophy in Russia, Canada, and a number of American universities, including, since 1982, in Case Western Reserve University in Ohio, where he retired recently. So Joel will be the moderator tonight, and without further ado, I would like I call on Dr. Alvarado to say a few words and introduce our main speaker. Dr. Alvarado.
Thank you, Dr. Fleischman. It's really a pleasure to be with you all this evening. I'm Emmanuel Alvarado. I serve as Department Chair for Social Sciences at Palm Beach State College, and as such, I have the honor of working closely with Professor Anderson, and it's my pleasure to introduce her this evening. So Dr. Anderson earned her PhD from Michigan State University with fields in labor economics and public policy. While at Michigan State, she was the Policy Analysis Director for the Institute for Public Policy and Social Research. She also worked at General Electric in accounting and finance. She's taught for 24 years at the University of Wisconsin-La Crosse, where she engaged in research on the status of women in the economy, as well as environmental economic issues. Prior to coming to Florida, she also worked as the Arizona director for the Campus Election Engagement Project, a nonprofit organization whose mission is to get college students registered and out to vote. So welcome, Dr. Anderson, and thank you so much for agreeing to speak to us this evening. I think you're still muted.
You're muted.
Okay, thank you for having me, and thank you for that wonderful introduction. I would like to share my screen if it works. So let me see.
I can give you control.
Sure. That would be
The only thing I ask is if someone comes in late, it will appear on your screen. You just let them in.
and let them in. Yes, I know.
Okay. Sorry.
Yeah,
about
I know
that.
how to do that.
So
Okay.
the professor thing here. All right. So let me
Yeah.
give you control. Make host. So you are now the
sorry.
host.
Okay. All right. Share. Ignore all the tabs I have open. All right. I think. Make sure this works. Okay.
I love this title, by the way.
Yeah. Oh, right. A question mark. Okay.
Yeah, I love it. We should have, that's the way we should advertise it.
Oh, yes. Was it averted or not? Okay. Let's see. See, I should be able to. Oh, there it is. Okay. Yes. when I first titled it, it was banking crisis. And now it's banking crisis averted ? So there's many pieces to this saga, and there are still some moving parts. So what I'd like to do is help us, glue it all together, and so we can sit back and look at the big picture, hopefully. So before we begin with Silicon Valley Bank, just some information about U.S. banks. Some of you might know this, some of you might not know these things. First, banks are private companies, and that's a surprise to a lot of students. Banks are not owned by the government. One of their goals is to maximize profits. And so that's one piece of this, and that frequently gets banks into trouble. Silicon Valley Bank, in fact, was the 16th largest bank in the United States out of about 4,000 federally insured banks. So we'll talk also about that at the end. Like other banks, or other businesses, banks are regulated. And the two main regulators of banks are the FDIC and the Federal Reserve. The FDIC, you're probably familiar with, the Federal Deposit Insurance Corporation. You walk in the bank and there's a sign that says that you're insured up to $250,000. So that means that if the bank fails, you will get up to $250,000 of your money back. And I think most people probably don't have or shouldn't have more than $250,000 in their account, because checking accounts earn terrible interest rates. So this will also be an important piece of the puzzle. Now, the Federal Reserve, besides being in charge of ensuring banks are acting safely for their consumers or for their customers, they're also in charge of monetary policy. And one of their goals is to bring inflation down to about 2 or 3%. Now, currently inflation is 6%. And a year ago, which is lower than what it was a year ago, I think we all remember, in June, the inflation rate was 9%. So it's come down, but it's still pretty far from the 2 or 3% inflation rate that we're comfortable with. Now, another piece here is that when interest rates rise, bond prices fall. So whether we're talking about corporate bonds or, in this case, government bonds. And government bonds are treasury securities that the federal government sells to investors when they need to borrow money. So when the government engages in deficit spending, when it spends more than it takes in tax revenue, it has to borrow the rest. And they do that by issuing or selling treasury bills, treasury notes, treasury bonds. So that's another piece of this. And then finally, our banking system, like most other banking systems around the world, is a fractional banking system. And that means that it holds only a fraction of total checking account liabilities as cash in its vault or as a reserve in the Federal Reserve. So just to give you an example, and this is a very, very basic, let me put this down here, balance sheet of a bank. We have assets equals liabilities plus net worth, typical balance sheet. We're going to ignore net worth for this presentation. Net worth is also called owner's equity. So when you deposit, let's say you depositing $100 cash in your checking account, that becomes a liability for banks. They're also called demand deposits because the bank owes you that $100 on demand. Okay. As far as its assets, when you take that $100 of cash into the bank, that becomes an asset to the bank. So given that the probability of all these $1 million of depositors wants to withdraw their money at the same time, the probability of that happening is very, very low. Banks learned a long time ago that they did not need to hold 100% of demand deposits or checking account liabilities as, say, cash in their vaults. And let's think in terms of cash to make it more concrete. So the Federal Reserve sets a reserve requirement. And let's say, for example, it's 10%. That means that the bank has to hold 10% of cash, checking account liabilities as cash in the vault. And then they can put the rest of it to work for them. And there's two primary ways that they use, in this case, the $900,000 that they receive from depositors. They can lend out some of that money and charge interest rates on those loans. And that's one way of generating income and maximizing profits. And the other way is by making investments primarily in government securities like treasury bills, bonds, and notes. Now, treasury bonds are the longest term government securities. They don't mature for 10, 20, or 30 years. So a note about Silicon Valley's assets. They invested a large percentage of their portfolio in these long-term bonds. And we'll talk about why in a second. Okay. All right, so back to Silicon Valley Bank. It was known as kind of the sexy tech bro kind of bank that, you know, lent to wineries in Silicon Valley, but they definitely catered to venture capitalists and to early tech startup firms who could not get funding, could not get loans from any other bank, because banks are supposed to be kind of conservative in their lending and in their investing because they're playing with our money. But Silicon Valley was a little different. They took more risks. They made loans to startups, which was more risky because a large percentage of startups fail. So because they were making these risky loans, they charged these companies higher interest rates to compensate for the higher risk. And so because they did that, they were able to pay a higher interest rate on their checking accounts compared to their competitors. And so that in turn attracted more depositors. The other thing they did that allowed them to pay higher interest rates on their checking accounts was they bought these longer term, higher yielding government bonds. And when you buy a long-term investment, that's kind of risky because the future's uncertain, especially 20 years out, 30 years out. So to compensate for that increased risk, longer-term investments like long-term bonds generate a higher interest rate, a higher yield. And that was very, looked very good for Silicon Valley Bank and other banks, again, whose goal is to maximize profits. So during the pandemic, the bank, Silicon Valley Bank, tripled in size. Went from $60 billion to more than $200 billion in assets. However, one thing to note, and this is another piece, 94% of its deposits were uninsured, meaning that 94% of depositors had more money in their account than $250,000. So 3 companies that you might have heard of banked with Silicon Valley. One was Roku, another was Roblox, and another was BuzzFeed. And Roku, for example, had $500 million sitting in its accounts. $500 million. So that's another big piece here. I have an asterisk here because I want to talk a little bit about the Dodd-Frank Regulatory Act that was passed after the 2007-2009 financial crisis, the Great Depression that brought on the Great Recession. And this act required that banks that had over $150 billion in assets had to be subject to more stringent regulations, more stress tests, more burdensome regulations. So it passed, but a couple years after, well, and it passed, it passed under the Obama administration. A couple years after, though, bank CEOs started lobbying Congress to relax those requirements. And the CEO of Silicon Valley Bank, Greg Becker, was one of the most strident lobbyists. And they were successful. In 2018, President Trump signed a law that relaxed the requirements so that only banks with more than $250 billion in assets needed to be subject to these regulations. And this passed in 2018 with bipartisan support. And that's key and interesting, except Elizabeth Warren. She obviously and definitely did not sign this onto this act. She thought it would hurt the banking system, and she's right. Okay. Okay, so let me just set the stage for the implosion of Silicon Valley Bank. First of all, the Fed started raising interest rates about a year ago to tamp down inflation. So they target the federal funds rate, and the federal funds rate last April was close to 0%. Right now, the federal funds rate is between 4.75% and 5%. So the Fed increased interest rates pretty quickly. Now, the question everyone's asking is, should the banks have been surprised? And I was reading some comments on this online, and there was one comment that stated, anyone who's taken principles of economics 101 knows that interest rates aren't going to stay zero forever. And economists and banks and financial institutions should have known interest rates were going to rise and planned accordingly. However, the one person who should not have been surprised was Greg Becker. He sat on the board of directors of the San Francisco Federal Reserve Bank branch. So he had a front row seat. Excuse my outrage. So the increasing interest rates had two effects. One, it slows down, spending. Consumers were spending less, businesses were spending less. Their business, it hurts business because consumers aren't spending. So businesses were taking out more money from the bank than they were putting in. They were taking out money to, pay their employees or pay their suppliers. On the asset side, Treasury bond prices started dropping because remember, interest rates and bond prices move in opposite directions. So what resulted was a liquidity crisis at Silicon Valley Bank. Their assets, remember, were tied up in long-term bonds that were losing value. So what Silicon Valley Bank did in order to raise cash to meet the needs of its depositors who were taking out money to pay their employees, for example, or pay their suppliers. So they sold all of their $21 billion portfolio of long-term Treasury bonds in one day. So everyone panicked, even people who should not have panicked, who knew better. So on Thursday, March 9th, they, after they sold these bonds, the day after they sold their bonds, they put out a statement. They announced that they had lost $1.8 billion in asset sales. So everyone got spooked, right? Investors got spooked. The price of Silicon Valley's stock, I think, dropped 60%. Venture capitalists got spooked. Depositors got spooked. And in fact, which is really interesting, a lot of venture capitalists like Peter Thiel and other really famous venture capitalists told their businesses that they help fund to withdraw their money from Silicon Valley Bank. And people listened to them. So in one day, $42 billion was taken out of Silicon Valley Bank. So we had, I'm going to show this. Right? Actually, I don't cook. So has everyone seen this?
Yes. From what movie is that?
It's a Wonderful Life.
Ah, it's a wonderful.
Yes.
We cannot hear anything though. Oh gosh, it's the Big Depression.
Run
You
on the
can see
bank.
this.
Yeah.
Okay, let me stop it. I don't think sometimes video doesn't translate well.
Jimmy's
me-
trying to convince the people to keep the money in the bank.
Yes, yes. And he does a pretty good job because their money, like whatever, Joe's money is invested in Betty's house. So that's how banking works. Now in those days, bank runs on banks happen not so quickly. Before social media, yeah, kind of had to drive past a bank and see a long line, and you think, oh, there must be a run on the bank, or someone would call you on your landline and tell you about it. This run on the bank was similar but different in that word got out on social media and through Twitter very, very quickly, like instantaneously, as you know. And like I said, the venture capitalists told their customer or their clients to get the money out of Silicon Valley Bank, and their clients told their friends, and their friends told their friends. So it happened very quickly. So that on Friday, March 10th, Silicon Valley Bank failed. And it was the second largest bank failure in history. And the first largest was during, or kicked off the financial crisis. And that was Washington Mutual. So as you can expect, tremors were sent through the banking industry out of concern that the large number of people who had uninsured deposits at other regional banks would panic and take their money out and move it to a bigger bank. You know, very much of herd mentality, you know, the psychology of these runs on the banks. It's very much of a prisoner's dilemma. You know, if everyone cooperated and kept their money in the bank, everything would be fine. But, you know, everyone's thinking, I don't know what my competitor is doing. So everyone pulls it out and everyone suffers. The other thing that was different with this run on the bank, unlike what happened with Jimmy Stewart's savings and loan, you don't, you know, take your passbook savings, you know, your passbook, savings passbook, and go to the bank, and then they give you your money. You can just transfer your money out of Silicon Valley with a push of a button. So it's very, very different now. So the question was, who's going to be next? And the next bank was Signature Bank in New York City. And New York's Signature Bank also catered to wealthy clients, law firms, real estate firms, and cryptocurrency firms. Like Silicon Valley Bank, 90% of its deposits were uninsured. So SVB's failure triggered a run on the Signature's bank. And that bank failed. The next bank that was in danger of failing was First Republic Bank. And I have a student whose mom works at a First Republic Bank. And so every day he'd come in and show me what was happening with the stock, First Republic Bank stock. It was down precipitously, and then it would go up 35%, and then it would drop. Again, only 68% of its deposits, 68% of its deposits were uninsured. And prior to First Republic, the panic at First Republic Bank, regulators said they were going to make depositors at Silicon Valley Bank whole. Now, the depositors at First Republic Bank weren't sure that the regulators would help them like they did for Silicon Valley Bank. So they started pulling their money out. In addition, First Republic, or no, it wasn't that. Never mind. That was another bank. Sorry about that. However, First Republic Bank, like a lot of regional banks, also had a large part of their portfolio tied up in these long-term treasury bonds. Okay, so what happened? What did government do? So it did a lot of great things. the first of which is acting quickly. Regulators shut down Silicon Valley Bank on March 10th, on that Friday. They shut down Signature Bank on that Sunday. Over the weekend, federal regulators promised to make all depositors whole, even for those funds that weren't protected by the FDIC. Didn't matter if someone had $5 million in their account or $25 million in their account. The Fed and the FDIC would ensure that these depositors would get all of their money back. So one thing we can talk about this. Some critics of this policy said that this was political, that this, maybe not political, maybe political isn't the right word, but this was due to the very wealthy and connected and sophisticated depositors and their friends of Silicon Valley Bank. And they use their megaphones to demand that government reimburse all the depositors. So people like Mark Cuban was out there saying it's not the depositors' fault. All the depositors' money should be given back to them. And Mark Cuban went to my high school. Anyway, the other thing that the Fed and the FDIC emphasized was that taxpayers would not be paying for this bailout, and it would be paid by a special assessment or a tax on banks. So there is a piece of the law, it wasn't just passed now, that said if something like this happens, that could potentially turn the banking crisis into a contagion, banks would be taxed and depositors would be reimbursed. Now, they're not even calling this a bailout because it's not designed to bail out investors or CEOs or executives. Okay. The Fed and the Treasury Department also said that they would lend money to banks when they needed it, so they wouldn't have to sell these long-term Treasury bonds at a huge loss. Janet Yellen, who is the Treasury Secretary, who used to be the chair of the Federal Reserve, and Jerome Powell, who is currently the chair of the Federal Reserve, also negotiated with the 11 largest banks in the country, like JP Morgan, Citibank, and Wells Fargo, to deposit $30 billion in First Republic. To help First Republic and to show support for First Republic, to show that they have confidence in First Republic, and to help shore up First Republic's balance sheet. And then finally, President Biden went on TV and Janet Yellen went before Congress to reassure people that the banking system is fine. So I heard an analogy. It's like when parents see their kids fall and the kid looks up at the parent to see how they should react. And if the parent is calm, then the kid doesn't cry. So that's what President Biden and Janet Yellen did. Try to keep people calm, to reassure them that the banking system was healthy. So these are continuing developments, pieces in this saga. There is accusations of insider trading. So for example, Greg Becker sold over $3.5 million of his stock in Silicon Valley a couple of weeks before the bank failed. Another interesting, I guess, fact is that Barney Frank, you know, the Dodd-Frank Regulatory Act, sat on the board of directors of Signature Bank. And Signature Bank has disappeared. There was another scare that did not materialize when Credit Suisse, a bank in Switzerland, was on the verge of failing. Actually, and so there was this scare that it would, what was happening in the United States would turn into a global situation. But Credit Suisse was in trouble, just never really recovered since the financial crisis of 2007, 2009. They were hit with scandals, mismanagement, management turnover. So Switzerland actually nipped their potential failure in the bank in the bud by negotiating the purchase by UBS of Credit Suisse. What's significant here is that on March 22nd, about a week after the failures of Silicon Valley and Signature, was that the Federal Reserve increased interest rates again because inflation is not where we'd like it to be. And by raising interest rates, it sent a signal that the banking industry is fine, that they're not concerned that this was going to become a contagion. And so by continuing to raise interest rates, it sent that signal. They did not increase interest rates of the federal funds rate as much as people thought, probably because of the banking situation, but they did raise interest rates. On March 21st, First Citizens Bank bought Silicon Valley Bank. And on March 28th, just last week, top Federal Reserve and FDIC regulators testified before the Senate who are trying to get to the bottom of this implosion. So they're trying to determine, you know, for example, whether or not this implosion occurred because of the law that was enacted during the Trump administration that relaxed regulations on smaller banks, or was it because regulators just weren't doing their job? And then finally, mega banks, you know, like the JP Morgans and Citibanks and Wells Fargo are benefiting from new customers and deposits. So people are leaving those regional banks and moving to these bigger banks. And they're definitely benefiting from that, from this situation. Okay, so I have here some questions that are raised by this event and that we can talk about, and any other questions that you have. I'll start off with this one. Who is to blame? And there was a lot of finger pointing. Are regulators to blame for not flagging the problems with Silicon Valley? In fact, they had flagged Silicon Valley, I think, up like a year ago, but it seemed that nothing changed. Moody's, one of the rating services, had told Greg Becker that they were going to downgrade Silicon Valley's bank stock. And that happened fairly recently, right before the failure. Was it the Fed? Was it the Fed who just raised interest rates too quickly failing to realize that the effect on banks that held a large percentage of long-term government bonds, or was it SVB themselves? And analysis at this point, now that we can kind of step back, analysts are saying that it really is due to poor risk management by Silicon Valley Bank, that they were gambling with depositors' money. In their drive to maximize profits, they were gambling with depositors' money. So here's other questions that we can talk about. Are there too many banks in the United States? So as I said, we have 4,000 federally insured banks. So this doesn't even include savings and loans or community banks. Other countries like in Europe have 3 or 4 big banks. So should we have a few large banks? So if there were fewer, say like 10 banks, something like this happened, the Treasury, the Secretary of the Treasury, the Fed could just get these people in a room and figure out what to do before a panic occurs. Should the depositors who had large amounts of uninsured deposits in a bank be made whole? And depositors maybe, and this is something I comment, but investors and executives know. So it's like Wall Street versus Main Street. I have some quotes here. Why subsidize affluent bank executives who failed their depositors? Why should we help executives who took the risks and are very loud about reducing regulation? They should not be helped. There's another question. Why did the venture capitalists who should have known better, why did they feed this panic and tell their clients to get their money out of Silicon Valley? Silicon Valley was okay. I mean, it was going to be okay. Yeah, they lost $1.8 billion, but they had a large amount of assets. So that was curious. And finally, are we headed into a recession? And that's a question that we can also talk about. So I'd love to have a conversation. I don't have all the answers. This might seem trite here. Diversify. That might seem trite, but there's repeating to some of these well-paid bank executives. So, okay.
Thank you, Donna. I'm going to try to take back control if I can figure this out.
Perfect.
But Joel is going to moderate.
Yeah.
Okay, well, I don't know if I'm if I'm taking questions or making my own comments. Am I on?
Yes.
Yes.
Well, it was an excellent presentation, so it's hard to know where to begin. I've put down 37 questions, so let me just take a couple of those. My big question here is, why should we care? And that's not a facetious question. We could easily design, banks came about because they were the primary lenders to commercial industry, and they were the primary lenders for homes. We don't need them for homes increasingly, and there's sort of a quasi S&L kind of group, and mortgage brokers and the feds who take charge of that. And commercial loans in the world are venture capitalists and hedge funds and life insurance companies who put money out and all kinds of things. So we don't absolutely have to have traditional banks. And if we do, JP Morgan will exist forever, unfortunately. So the question is, why should we care if banks fail? Because we could easily design a system where we could largely protect depositors. We could, let's say, up the limits to 1 million. That probably wouldn't kill us. And then we could allow people who have more than that, who are more sophisticated, to buy insurance the way you buy insurance on anything. You want FDIC type insurance, you pay for it. And meanwhile, the insurance companies are going to say, if you want to get a cheap rate, go to JP Morgan. If you want to get a bad rate, go to your local community bank in Silicon Valley. We shouldn't care about, I mean, we're essentially a capitalist country. And so why should we care about depositors? I mean, deposits fail. I mean, not depositors, investors. Investors lose money all the time. If they want to put their money into a bank that is reckless, then so be it. If they want to put it in one that's prudent, if they want to take a chance, like Tesla was a chance, fine. If they want to go prudent and get some little engine that goes on forever, like a utility, they can do that. That's so. I guess so. My question is, why the hell should we care at all? Why don't we just design banks that protect depositors a bit, offer them insurance, the Peter Thiels on buddies on the high end who actually know how to get insurance or what it is if they want to buy it, but offer a package that allows that, and then the depositors are protected, and to hell with the investors. They have no more rights than investors in any other company that fails. I mean, the GM investors lost their shirt. Lots of companies go out entirely. And banks are an old notion. Companies don't borrow from banks. Banks are terrible as lenders. So why care about any of it? That's my question.
Is that a question to me, and that could be a question to everyone?
Well, you're the expert.
Oh, I'm not. Well, I am going to say that I read a similar comment, but it was from someone advocating cryptocurrency, saying, "Oh, this is what you get when you have a centralized banking system and you have a centralized money system, and it should all be decentralized." Now, I know nothing about cryptocurrency, but to me, that's even riskier. I should have gone and when you did your session on cryptocurrency. But to your point, I think that's an excellent idea. I think of the moral hazard that's created when these banks, what the FDIC says, okay, we're not going to make your depositors whole who have more than $250,000 in their accounts. Now the Fed has bailed them out, and it is a bailout, even though taxpayers aren't paying for it, but it's a bailout. So what's the message? Isn't the message that do what you want because the Fed and the Treasury is going to bail you out? So isn't that a prescription for more risk? So I like that idea. I think that makes sense. We are a capitalist economy, and I like that idea of, well, then let's sell insurance. So, but I like that.
Well, how can I argue with you if you agree with me?
Yeah.
Oh no.
No. I'm just.
Yeah. No, I think that makes sense.
There is this, many years ago when I used to be a lawyer in a previous life, I was part of litigation for investors in National City Bank, which was part of the banking crisis, and it was the largest failure of bank history because the stock went from 38 to 2 and then was sold. So the actual loss was the greatest in banking history. And the question, should we care about the people who lost 95% of their savings? And PNC, who took over, said no, to hell with those people. And I was representing those people, but maybe they're right. And there, even when a bank fails, there is equity. So if you take out the owner's equity,
Mhm.
net worth, and you roll it back in on top of the 250,000, you've got a fair, I mean, you know, in the way that bondholders always get their money first. So
Yeah.
do depositors. I mean, actually creditors get it before bondholders. They're sort of form of
Mhm.
creditor. And so I wonder about all the hand wringing with banks, which strike me as such an archaic
Oh,
institution.
I
Anyway,
don't know. Yeah, I mean, that's a good thing. That's a very good question. And it seems that the regulators, what they're talking about is doing is the exact opposite. They're moving toward more regulation, more centralization, more, I don't think they're open to those kinds of interesting ideas. I think we are just wedded to this idea of banking. So I don't know. I think those are really good questions and ideas.
I see Luis has his hand up. Is that right?
Yes. Yes. I wanted to ask you a question. Thank you so much. I've learned tremendously. Donna, I think you've done a great job, really.
Thank you.
You know, between you and the podcast that I'm listening, I think I'm getting something, probably not. Why? My question is, why would the banks actually invest so much money in bonds, knowing that interest rates could go up, particularly because we've been talking about inflation for a long time. So what was the logic of this large investment in bonds?
And I think that I don't know the answer to that. I think, and I think a lot of people are shaking their heads over that. I don't know. I just don't know the answer, and I'm sorry. I don't know if anyone else has an inkling as to why they were so
Reckless.
Right. That's a good word. Why they were so reckless. In that sense, and being so reckless, why didn't they hold more cash? Given that they, you know, their assets, the bond assets might come down, the bond prices would come down, but they didn't. Another thing I read about Silicon Valley Bank, that their risk management, risk manager had retired, and another risk manager didn't come on board for several months. Now, I don't know if that had anything to do with it in their case. But I don't know. I don't have an answer to that. That's a very good question.
Let me go back
Thank
to
you,
one of
Donna.
your
Thank you.
suggestions. Oh, go ahead, Luis.
No, that's fine. I think Professor Anderson actually answered my question. Thank you.
You're welcome. I'm sorry, I have just no idea about why they acted that way.
Let me go back to one of your suggestions, one of your ideas. I agree that it's absolutely true that in a number of other countries, and I mean, I used to live in Europe, there are only several big banks. And then there's often a couple of very large foreign banks that come in and do business in that country. And so, and then the home mortgage market is shifted off to a different group. And credit cards may be part of yet a different group, or Visa, MasterCard kind of things. And the lending still remains either with some very big banks to very traditional, very highly creditworthy companies, kind of the old thing. You can only borrow money if you don't need to borrow money. what's wrong with that? I mean, what's wrong with sort of JP Morgan, Bank of America, you know, a few other big banks? I mean,
Citi, Wells
Key
Fargo,
Bank,
yeah.
Wells
Mhm.
Fargo, a Key, something. I mean, what happens if you just cut down that and they do have the money to run JP Morgan, you have to run $1 trillion or something. I mean, it's a big bank run.
Mhm, mhm.
So do you think that's a good idea? Do you think that because they could regulate that, they could sit there and say heavy duty regulation for everybody, just like JP Morgan, and then a lot of banks had just closed because they couldn't meet those kinds of regulatory demands. You think that's a good idea for the economy?
So as far as regulation, and that it definitely would make regulating banks more effective, more efficient, and easier when there's 10 or 11 banks rather than 4,000 banks. The United States is very resistant to bank mergers, as you know, because of our resistance in some resistance in some industries to mergers because of monopoly. We're afraid of monopoly behavior. And when an industry is controlled by a few big companies, they treat us like crap. Just look at the airline industry. And so there's a concern that when there's big 10 or 11 big banks, we're not going to get the service that we deserve. And what's nice about these regional banks or community banks or whatever is that they know us, they know the community, they sponsor a little league team or a girls softball team. And so that's what we might be giving up, even though JP Morgan could have branches. So
I mean, but no. Do you believe that? And the reason I ask is that banks, including small banks, treat us like crap now. Number one, I mean, on the whole, most people's view of banks is even you're the ones, if they need an auto loan, if they need an auto loan, the bank's probably the last place they go, and if they do, they don't get treated very well. But which is another reason banks aren't that interesting in some ways.
Yeah.
But there's there's a real cost to that.
There is.
To the little league team, which is you have a bunch of cowboys running lots of local banks just so that they have a little league team, and it's just not clear that that's and you're spending tax money on regulating people that are sort of regulatory proof because they just can't get it right, and there's and they don't have the funds and they don't know what they're doing, and then you then have to bail them out, and nobody, let's say, if you were insuring them if you're insuring deposits in the private world, and somebody was, let's say, a Prudential or a Chubb were actually rating people for insurance, you'd rate them as crap. But I mean, I still do take issue that the small banks treat you all that well, but even if they were nice to me, is that good enough? Is there any way to run a financial system? Pat on the back in a little league team, but meanwhile the country goes to hell.
Yeah, right. Well said. And I guess I would have to say, I think that a few large banks with branches in the communities is more efficient and would serve us better. However, the likelihood of that happening, I just don't know. Like I said, we're very resistant to that in the merging.
Because let me ask you another alternative. The other alternative, of course, is that we follow the model of the auto industry. So the auto industry went down from, 8 to 5 to 4 to 3 to whatever.
Which industry?
Yeah.
And then
which industry you mentioned?
The auto industry.
Oh, the
Auto.
auto industry.
Oh, the
Okay,
automobile
auto.
industry, sorry.
Yeah,
Okay,
right,
automobile.
right.
All
And
right.
then, and so nobody was making Studebakers anymore, and so the cars were presumably better, but in that they were mediocre international. I
Mhm.
mean, this whole idea of antitrust, the GM had a monopoly is crazy when GM is been dwarfed by Toyota and Volkswagen
Right, right.
and so
Yeah.
and so you know what would be, I mean, wouldn't the logical thing, again, if you're a capitalist, or you just believe in a market economy regulated, which is, you know, we social democrat, with having, you know, going down to a few banks and then letting in, you know, Barclays or Deutsche Bank
Oh,
or H, you know,
yeah,
and let them compete. And if they compete, they compete. Like, you know, people buy more Toyotas and Hondas
yeah.
and they buy
Right,
Ford,
right.
or and they'll probably never sponsor the little league team, Deutsche Bank.
But
But is that it? I mean, is that, because I see this whole thing with a crisis and everybody anxious and everybody scratching their head and people having hearings, and Elizabeth Warren
yeah,
said, "Thing, I told you so," and she did.
and
But
she did.
we're saving a dinosaur. It's like we're saving General Motors, the old General
Yeah,
Motors.
right.
Can I step in?
Yes.
We're, I think my job is to make sure we stay relatively on time.
Oh,
And
okay. Oh, what time is it?
And I don't see, it's about 10 past 8.
Oh, okay.
And I don't see any other questions. So if it's okay with you, Joel, I'll wrap up. Is that okay?
It is okay with me.
Yes, thank you. And first of all, I wanted to thank Emmanuel, is that
Emmanuel.
for co-sponsoring this too. I didn't mention that at the beginning, from Palm Beach State College. So thank you. I also, I see Carol has a question, but
I do. It was just one question for Donna. You know, the banks are like the fabric of America. The local bank, you know, have been going on forever and ever. My question to you is, if in fact, you know, there's regulators issuing reports, Moody's issuing a report, and if the reports are good and the bank fails, I don't believe in moral hazard either. But does the regular American person, Joe, know about the intricacies of the banking system, and should they be held responsible?
So wait, so your question is, should,
Right,
In-
we
in
talked
defense
about
of the-
moral hazard, but we're talking about a very sophisticated industry, and a lot of folks don't understand the ins and outs of it. And we have all this oversight, and yet we're having bank failures. And you know, should these people be reimbursed for their funds when, in fact, in good faith, they invested them with a bank that they thought was stable and secure?
right, and that is an argument, you know, I've heard that, but also is that should depositors have to know the ins and outs of their bank, you know, because banking is can be very complicated. And so we rely on the regulators and the ratings systems to tell us as the depositors what's going on. So if even these banks are failing, what are we supposed to do? And you're right. And I think that's I don't know. I think that's a really good observation. Tough call, save them or let them fail. Yes, from Lil.
Yeah,
Yes,
you know, I know Steve wants to wrap up. I paid 6% interest rate on a car last week because I knew it was going to go up, but I just wasn't ready last year, and it hurt so much, right? 6%.
yeah.
But you know, it's funny we didn't hear too big to fail that phrase before, but it is right. It all comes down to how many are enough, and should we, you know, who do we save first? These are really tough things, but I think you mentioned it earlier that they got out of control at SVC because they were reckless, because we let them, because there's no the regulations were taken away, and then the regulators, let them get away with this. So we've learned our lesson. I think they know how to fix it. There's just no political will to do so. Anyway,
By the way,
thank you.
is there going to be any re-regulation again? I remind you that Barney Frank was one of those who actually lobbied hard for this reform of 2018.
Oh, yeah.
Are
Yes.
we going just to roll this back and go back to the regulation that existed under Dodd-Frank's?
I guess it would depend on who's in power politically. Right?
Yeah.
So I think that you mentioned who's in power politically, and Sean rose up again. This is his area of expertise. So
No, I'm not going to say anything. I'm just going to listen. I know you want to wrap it up, but wow, this is so timely, as you said at the beginning, of course. And thank you, Donna, for really laying it out for us in a way that we can understand and realize it. Maybe the question mark, the worst is still to come.
thank you, Sean. I think it's important. I think this is one of those events that we're having, and it doesn't happen that often, where we may ask you to come back again for part 2. So,
Right,
Donna,
we'll see
so,
what happens.
yeah,
Yes,
but
thank you.
I do want to say that we have, I just wanted to mention Carol Huberman, who asked the previous question, is a professor of public administration and has sort of a quasi joint appointment with the business school. So she comes with lots of experience. And I mentioned Sean earlier. And I do want to mention that Michael Landau here is a retired businessman who has been one of our primary funders over the years and supporters. So thank you, Michael, for coming. And I wanted to recognize Laura Fleischman, Luis's wife, looking, am I allowed to say this? Looking great as usual. I'm not sure if we're allowed to say that sort of thing anymore, but hi, Laura. And for those who are tuning in, this will be put on our website and our Facebook and YouTube site. So for those who tune in later, you all know I mentioned earlier that we are 501c3, and when you log on to our website, right on the front page is a donate button that people can click and help support us to bring terrific programs like this. We don't take a salary. We have a web guy. We want a professional web page because that's our what people see, and that's what cost us money. So what Louis?
Our marketing is
our marketing. We have true. It is our marketing. Our website's our marketing. So with that, Joel, thank you for moderating. Donna, thank you for everything you do. And
thank you for having me.
Presentation.
Thank you very
for
much.
having me. Thank you for the questions and
and
comments.
And good evening to all. Bye-bye.
Bye-bye.
Bye.